$295.6 billion. Yeah, that massive figure is the total trade volume between China and Africa in 2024. And that actually marks the fourth consecutive record year for this economic relationship. But hey, if you think this is just about buying more commodities and selling more manufactured goods, you are missing a much, much deeper structural shift that's currently underway. We are talking about a shift that's fundamentally rewriting the rules of international trade, finance, and infrastructure.
Welcome to The Explainer. Today, we're going to unpack the evolving macroeconomic relationship between China and Africa. And by looking at the actual facts on the ground in Zambia, we get a front-row seat to how a totally new paradigm of economic pragmatism is rapidly replacing old ideological alignments. To make sense of all this, we've broken it down into 4 key pillars today. First, the zero-tariff trade shift. Second, revamping vital infrastructure. Third, the rise of the yuan. And finally, we'll ask if this is truly a new development paradigm. Let's get right into it. Okay, kicking things off with part 1, the zero-tariff trade shift. We're looking at how the very basic rules of market access are being rewritten. So the absolutely crucial thing to grasp here is the sheer scale of what happened in May 2026. China implemented a zero-tariff policy that now covers 53 African countries, and it applies to literally 100% of tariff lines. This is a massive expansion from their previous 2024 policy that only covered 33 least developed countries. China is actually the first major global economy to unilaterally grant full tariff exemption to all African countries it has diplomatic ties with. So what does that mean for you and me? It means everything from agricultural goods to light manufactured products can now enter the Chinese market without paying a single dime in customs duties. Now, this really exposes a fundamental difference in how global powers operate. When we look at Western preferential trade schemes, things like the US AGOA or the EU's GSP+, market access is explicitly conditioned on internal benchmarks. We're talking governance reform, human rights conventions, domestic regulatory standards. The Chinese model, on the other hand, operates on a completely different conditionality. It simply requires diplomatic recognition of Beijing. And that's exactly why 53 out of 54 African countries are included in this. The sole exclusion is Eswatini, simply because they maintain diplomatic recognition of Taiwan. It's just a completely different rulebook for trade access. You might think zero tariffs just magically change everything overnight, but the data tells a slightly different story. Right now, 89% of Africa's exports to China are extractives. For our case study in Zambia, that means copper. And here's the kicker. Copper ore was already entering China duty-free under the old rules. So the true opportunity of this new policy isn't really in traditional mining at all. The real game changer lies in value-added, non-traditional exports, things like processed minerals, honey, soybeans, and gemstones, which previously got hit with Chinese tariffs of up to 25%. The door is now wide open for some serious export diversification. But look, you can't export those new goods if you can't physically transport them, or if you don't have the power to process them in the first place, right? That brings us to Section 2, revamping vital infrastructure. Just look at the famous TAZARA railway as an example, linking Zambia to the port of Dar es Salaam in Tanzania. Back in the 1970s, this was built as a turnkey Uhuru or freedom project, and it was entirely funded by an interest-free loan from China. Fast forward to 2025, and we're looking at a very different model. It's a $1.4 billion public-private partnership concession with a Chinese corporation. This 30-year deal is specifically designed to bring in private sector expertise to rehabilitate the aging 1860-kilometer line, modernize the rolling stock, and dramatically boost freight capacity along the central corridor. It's a massive shift from ideological aid projects to commercially driven, efficiency-focused investments. And to power all that new industrial growth, Zambia absolutely needs reliable electricity. Enter the new 750-megawatt Kafue Gorge Lower hydropower project. Strategically located in southern Zambia, it taps right into the massive Zambezi River system. Now, this was also funded through a public-private partnership, with the Zambian government taking a 15% stake and Chinese financiers backing the rest. When you actually zoom in on the engineering here, it's honestly fascinating because it's integrated right downstream from an already existing dam, and it's situated in this really steep, narrow gorge with basically no agricultural land. It manages to generate super high power output with an incredibly low environmental and social footprint. The reservoir submerged almost no critical habitats at all. And get this, remarkably, only 25 fishing families had to be relocated for the whole shebang. It perfectly illustrates how vital infrastructure is being custom-built to support Zambia's new economic ambitions. Okay, so we've got the trade rules and the physical infrastructure, but you also need the financial systems to make it all work. Let's move to Section 3, the rise of the yuan bypassing the dollar. To really get this financial shift, we have to talk about CIPS, which stands for the Cross-Border Interbank Payment System. Think of it essentially as China's alternative to the Western-dominated SWIFT network. By joining systems like CIPS, African banks can process their international transactions directly in Chinese yuan without ever needing to convert their money into US dollars first. It completely removes the intermediaries, drops transaction costs, and really speeds up settlement times. In fact, Zambia recently made history as the very first African country to accept mining royalties and taxes in yuan. Now, why would they do that? Well, it boils down to three entirely pragmatic realities. One, China is the dominant buyer of Zambian copper anyway, so the revenue is already sitting right there in yuan. Two, Zambia's faced some pretty severe dollar liquidity shortages, so trying to force everything through the dollar really strains their reserves. And three, over 40% of Zambia's external debt is owed directly to China. So you see, this isn't some grand political statement against the dollar. It is pure, unadulterated economic pragmatism. When your biggest customer pays in yuan and your biggest creditor accepts yuan, keeping the currency in yuan just makes total sense. And the actual financial benefits here? They are absolutely staggering. Take Kenya, for instance. They are projected to save $215 million annually simply by converting their Chinese railway debt from US dollars into yuan. Because US interest rates soared recently, Kenya's dollar loan rates jumped to around 7%. By swapping that debt currency over to yuan, they get to lock into China's much lower rate of around 3%. It's a highly practical, immediate solution to a crushing debt burden, and we're seeing countries like Ethiopia already looking to follow suit. Which brings us to our final section today, Part 4, a new development paradigm. Are we witnessing genuine structural transformation here, or just a new form of dependency? There's this really insightful quote from the European Journal of International Law blog that hits the nail on the head regarding the risks. As they point out, while the Chinese zero-tariff arrangement offers massive immediate benefits, it is, structurally speaking, a unilateral grant which may be modifiable or revocable at will. We've seen Western preferential trade policies expire or get revoked based on shifting political winds before. If African economies become entirely reliant on the goodwill of Beijing, just as they were previously reliant on the goodwill of Washington or Brussels, then the core dynamic of dependency hasn't actually been broken at all, has it? It has just changed addresses. So, that leaves us with one final, absolutely pivotal question. Can Africa convert this unilateral preference into real regional production capacity? Because the real game changer isn't just shipping raw materials to China duty-free forever. It's about using these new zero-tariff rules, combining them with better railways like TAZARA and more power from places like Kafue Gorge to actually process goods locally. If agreements like the African Continental Free Trade Area can spur domestic industrialization, then this new China-Africa paradigm could genuinely be the launchpad for true economic independence. But if it only reinforces the old habit of exporting raw copper and importing finished goods, the cycle just continues. What you really need to take away from this explainer is that the tools for real transformation are right there on the table, but the next step is entirely up to how they're used. Thanks for joining me on this explainer, and keep questioning the structures behind the headlines.